Yeah, this is fixed income issuance and trading. We need to describe fixed income market segments and their issuer investor participants, type of fixed income indexes, compare primary and secondary fixed income markets to equity markets. The fixed income instruments and markets are often characterized by issuer type, who is issuing something, what is the credit quality of what is being issued, what is the time to maturity, and additional features such as which currency is the investment in which geography is this investment going to be, and what are the ESG characteristics. Fixed income indexes are characterized in a similar manner and serve important function like the role of equity market indexes in the stock market. Like other financial markets, fixed income markets are composed of primary markets in which the issuer raises financing from the investors with new issuance, and secondary market where the investors trade existing instruments with other investors. Given the bond finite maturities and other features, there are important distinctions in fixed income markets from primary and secondary markets from equity. Fixed income instruments and markets are typically characterized by three dimensions: issuer type, credit quality, and time to maturity. Issuer type, time to maturity, and credit quality. Fixed income investors have corresponding positions along the credit and maturity spectrum as they seek exposure to certain risk and attempt to match the cash flows of known future obligations. Similar to equity market indexes, fixed income indexes track the return of groups of securities that meet their inclusion criteria. Indexes are used to evaluate market performances. इंडेक्स को इवेल्युएट करते हैं क्यों? मार्केट परफॉर्मेंस इवेल्युएट करने के लिए benchmark the performance of investments and investment managers and form the basis of indexed investment strategies. Fixed income indexes can be classified as broad-based aggregate indexes with vast number of constituents, or narrower indexes that focus on criteria such as issuer type, credit quality, and time to maturity. Primary bond markets are market in which the issuer sells a new bond or bonds to investors to raise financing, whereas secondary bond market are where there is an existing bonds are traded amongst investors. Perfect. Let's go into the topic. Fixed income instruments and markets are typically categorized along three dimensions: issuer type, credit quality, and time to maturity. In contrast to equities, where issuers typically issue just one or two type of instruments, issuers often have many fixed income instruments outstanding. For example, a corporate issuer may have loan or both loan and bonds, either on a short-term basis to finance working capital or a long-term basis for capital investments. Some large companies also issue commercial paper, a short-term bond to finance working capital need that can be collateralized by specific assets. This debt instrument may be varying currencies to hedge exposure and broaden access to investors. For example, at the end of 2021, Apple Inc. had over 80 fixed income instruments, but a single equity instrument, which is your common equity stock. Perfect. Fixed income investors have corresponding positions. Investors will have corresponding positions along with credit and maturity spectrum as they seek to gain exposures to certain risks and to match the cash outflows of known future obligations. Near term obligations and the desire for liquid cash alternatives are often met with money market securities, while investors may assume greater interest rate risk with long term bonds to meet obligations further in future or pursue higher expected returns. Pension funds and insurance companies with long investment time horizon favor fixed income instruments with fixed periodic coupon cash flows and maturity profile that matches their long-term liabilities. Investors may take credit risk at any point on maturity spectrum to augment returns. So your default or risk free, if it is less than 1 year, it is a short term. If it is 1 to 10 years, then it is an intermediate term. And if it is greater than 10 years, then it is a long term. Default risk free money market funds, investment grade corporate issuers, your less than 1 year, your credit quality reduces with the higher yield. Your intermediary terms, it will be generally be your bonds, funds, and ETFs, hedge funds, distressed dash funds, and your greater than 1 year will be your insurance companies and the pension funds. A common measure of credit quality is credit rating. Credit rating are letter grade qualitative measures of an issuer's ability to meet its debt obligation based on both the probability of default and the expected loss under default scenario. अगर आपने डिफॉल्ट किया तो उसकी प्रोबेबिलिटी क्या है और जब आपने डिफॉल्ट किया तो कितना लॉस होगा, उसके बेसिस पे आपकी क्रेडिट रेटिंग आती है. Credit rating are given and maintained by credit rating agencies for both short term and long term debt and for issuers and specific bond issues. So your credit rating is on the issuer as well as on the specific bond issues. Two of the largest credit rating agencies in the world are Standard and Poor and Moody's. Many investors are restricted to instruments with credit ratings. Many investors are restricted to instruments with credit ratings, while limited percentage of portfolio invested in underrated instrument. Credit risk and credit rating is discussed in the later lessons. So the investment grade AAA is extremely strong capacity to meet financial obligations. Highest rating AA is very strong. A is strong capacity to meet the financial commitment, but susceptible to adverse economic conditions. BBB is adequate capacity. It has strong, not a strong capacity. It was extremely strong, very strong, strong adequate capacity to meet financial commitment, but more subject to adverse economic but more subject to adverse economic conditions. BBB negative is considered lowest investment grade by market participants. Then it is BBBB negative, BBBB and BBB negative. Then there is a speculative grade or high yield BB positive, considered highest speculative grade by market participants. Highest speculative grade by market participant is BB positive. BB less vulnerable in near terms but faces major ongoing uncertainties to adverse business, financial, and economic conditions. B is more vulnerable to adverse business, financial, and economic conditions but currently have capacity to meet the financial commitments. Then let's see other categories. CCC is currently vulnerable and dependent on favorable business, financial, and economic conditions to meet financial commitments. Uh, CC is highly vulnerable. Default has not yet occurred, but it is expected to be virtually certain. C is currently highly vulnerable to non-payment and ultimate recovery is expected to be lower than higher rated obligations. D is default obligation on financial commitment or breach of an imputed promise and used when a bankruptcy petition has been filed or similar actions taken. Developed markets sovereign issuers usually represent most creditworthiness borrowers within a market and often carry a AAA rating because investors often assume they will receive all promised interest and principal payments. MTM sovereign bonds they comprise of high default risk-free category. Perfect. Uh, Issuers rated BBB negative or higher are considered investment grade. BBB negative, BA3 on Moody's scale or higher are considered as investment grade. Issuers rated BB positive, BA1 on Moody's scale और lower are referred to as high yield. जब आप BB प्लस हो या तो उससे लोअर हो तो आपको हाई यील्ड गिना जाएगा. Speculative grade or junk grade. High yield issuers include new issuers for which investors are more likely to require collateral due to less stable operating cash flows, as well as formally investment grade issuers whose credit quality has deteriorated since the time of issuance, which are called as fallen angels. Perfect. So if we go above AAA, AAA, BBB, BB negative, all this was considered as investment grade. Then BB positive, and after that everything was considered as speculative grade or high yield. Sovereign government issuers typically have lowest credit risk in each market due to the sovereign rights to tax economic activity. Developed markets are often widely held by both foreign investors and foreign central banks seeking to hold reserves in developed markets currencies in form of interest bearing assets. Sovereign bonds are also serve important functions in the domestic financial system. Central bank often use domestic sovereign bonds to conduct monetary policy, borrowing or lending the securities to increase or decrease monetary reserve. Investment grade bond investors expect more stable cash flows. Investment grade bond investors they expect more stable cash flows, and default among investment grade issuers are relatively rare. Expected returns are therefore lower than those of the high yield bonds and usually comparable or modestly higher than those of sovereign bonds. High yield investors expect greater return for assuming higher probability of default and often compare returns to those of the equity investments. Now, what is fixed income indexes? Let's see what is fixed income indexes. An earlier module highlighted the role of market indexes in tracking the broad risk and return of different security markets, which enable the evaluation of market performances, benchmarking the performance of investments and investment managers, and forming the basis for indexed investment strategies. Fixed income indexes perform a similar function in bond markets as equity indexes in the stock market, but differ in three important ways from the equity counterparts. How is your fixed income index different from the equity counterpart? A single issuer may have many individual fixed income securities outstanding. All bonds that meet index eligibility requirement are included in indexes, causing fixed income indexes to have many more constituent securities than equity indexes have. Some indexes have over 10,000 constituents. So this will have many securities vis-a-vis equity index. The finite maturity of bond and the higher frequency of new issuance. There is a finite maturity of bond and there is higher frequency of the new issuance. This lead to more changes in constituents in fixed income indexes than the equity index. Bond indexes are usually rebalanced each month to both add new securities and remove those. So इसके अंदर rebalancing is more frequent, analogous to equity weighted by issuers market capitalization. Bond index constituents are usually weighted by market value of debt outstanding. Since bonds are issued by many type of issuers, broad bond indexes will reflect changes to the bond market composition over time. For example, increase in public versus private issuer debt, long maturities and deterioration in credit quality. Government issuers are large bond issuers. So many broad bond indexes may have high weight of government debt. The possibility of government debt exposure is high. If bond fund aims to match the return of a specific index, it will typically have a representative sample of constituent securities in order to match the index return. Because of complexity of bond indexes makes it impossible to purchase all the constituent securities. If you have to resemble it, you will have to be constituted in that way. Fixed income indexes can be classified as aggregate index with a vast number of constituents or narrower indexes. Constituent index, which is your broad, or narrower, based on criteria such as sector, credit quality, YTM, geography, and ESG considerations. The choice of index for investment manager performance evaluation is important and will be discussed in later in the curriculum. But generally speaking, the index chosen to evaluate an investment manager of fund should correspond to that managers of fund's investment strategy. Okay. Now the another point is primary and secondary bond market with the equity markets. Primary bond markets are market in which the issuers sell a new bond or bonds to the investors to raise capital. In contrast, secondary bond market is where you trade. As in case of an IPO for equity investors, an issuer approaching the bond market for the first time, that issuer represents the first opportunity for the fixed income investor to purchase an issuer's bond. Bond can be sold via a public offering in which any member of a public may buy the bond, or via a private placement in which only a selected investor or group of investors may buy the bonds. Similar to primary equity issuance, प्राइमरी इक्विटी इश्यूएंस होता है उसके जैसे ही, which typically involves a transfer from private to public ownership. Debit issuer is often replacing private debt such as bank loan with bonds. Example of the debut bond issuer includes new corporate legal entities formed after merger, companies that reach to a more mature stage of life cycle with more predictable cash flow and began issuing debt, and sovereign government that raise external foreign currency debt for the first time. For repeat issuers of fixed income securities, the process is far more abbreviated than the debut issuers, and for follow-on offering or of equities, whereas publicly traded companies that return to equity markets to increase their share outstanding do so under identical instrument. Fixed income issuer usually issue a new securities priced at or close to par. A less common strategy is to increase the size of existing bond with the price significantly different from par, which is referred to as reopening of the existing bond. So in bond also, there is the process of reopening of existing bond. For example, unsecured investment grade issuance of new corporate bond usually takes place within a several hour period as shown in diagram and timeline in exhibit 6. So let's say if there is an order book size is 100%, 9:15 transaction announced, 9:10:30 investors conference call, then at 12 noon there is a price guidance which is announced. At 1 p.m. there is a transaction launched, and by 3 p.m. the transaction is priced. Uh, at 9 a.m., underwriter and issuer agree to launch the transaction. 9:15 transaction amount, size, spread, and maturities. Electronic roadshow released. Order book open to investors. Investors conference call with issuer and underwriter at noon. Price guidance, size, and maturity subject to change. Order book close to investors. Transaction launch with final size, pricing, and maturities. Underwriter allocate transaction to investors. Transaction price, government benchmark, and coupon set. Final term sheet delivered. Bond free to trade same day or next day. Exhibit 6 is an example of the underwritten bond offering in which one or more financial intermediaries guarantee the sale of bond issue at an offering price that is negotiated with the issuer. Investors in such bond are usually very familiar with the bond indenture and financial statements of this frequent issuer. As in case of earlier this in the module, issuer of such bond have ready access to the bond market and often choose issuance timing as an opportunistic basis when market conditions are more favorable. The underwriter seeks to manage the bond order book to ensure the greater availability of larger institutional investors at the lowest possible spread across maturities. Frequent bond issuers use a shelf registration or a broad all-encompassing offering circulars that is updated regularly and may be used for a range of future bond issuances. Secured bond issuances among corporate high yield, secured bond issuances among corporate high yield, some special purpose entities, and other issuances is usually a longer and more involved process uh, than for unsecured investment grade bonds. Investor must familiarize themselves with unique and more complex covenant as well as use of both operating cash flows and collateral as source of bond repayment. For bonds or lower credit quality, the financial intermediary does not guarantee the sale and may serve only as a broker in the best efforts offering. This is, it tries to sell the bond issue on a commission basis at a negotiated price only if it can do so. In instances where the bond size is small, the issuer is less well known, and the terms are more customized, the bond might take the form of private placement or non-underwritten, unregistered offering of bonds sold to a small group of investors. Primary market issuance of sovereign debt usually takes place in form of public auction led by National Treasury or the Financial Ministry, which is discussed in the later module. Secondary fixed income market. While progress continues to be made with electronic marketplace such as market access, TradeWeb, fixed income markets are mostly code driven or over the counter markets. Major participants in secondary bond market trading include institutional investors, financial intermediaries, and central banks. Secondary bond market liquidity varies widely across fixed income market segments and even among bonds outstanding for single issuer. The bid offer spread or difference in price at which the dealer will buy or bid for from a customer and sell or offer to the customer. The bid offer spread. What? The bid offer spread or difference in the price at which the dealer will buy from a customer and sell or offer to the customer is a key liquidity measure. The spread is often quoted in basis point in fixed income securities. Bid offer spread is difference in price at which dealer will buy or bid from a customer. Dealer will buy from a customer and sell to a customer is a key liquidity measure, bid offer spread. The most recently issued or on the run developed market sovereign bond are typically the most liquid fixed income securities with primary dealers making active markets in large size with bid offer spread equal to a fraction of basis points in some markets such as Australia. Domestic sovereign government bonds are traded on an exchange. द सॉवरेन गवर्नमेंट बॉन्ड्स जो है वो एक्सचेंज पे ट्रेड होते हैं among corporate issuers. Recently issued corporate bonds from frequent issuers of higher credit quality usually exhibits the greatest liquidity and tightened bid offer spread. Underwriters and other dealers are more likely to hold trading inventory in recent issues and may therefore quote bid offer spread of few basis point. Bond of less frequent corporate issuers or more seasoned bonds of frequent issuers are rarely traded, leading dealers to quote bid of a spread of at least 10-20 basis point or more for small sizes. One exception that can increase trading frequency of seasoned issue is a significant deterioration in bonds quality, as in the following example. Fine enough. Bonds of issuers believed to be very close to or in bankruptcy, as in the previous example, are referred to as distressed debt. It typically trades in the secondary market at the price well below par because bondholders are unlikely to receive all promised future interest and principal payments. Investors with policies limiting their bond investment to high rated securities may be forced to sell distressed debt, while hedge funds and other opportunistic investors seeking more equity like return are often the buyers of distressed bonds. Distressed debt is traded until either the corporate issuer has liquidated its asset or its outstanding bonds have been restructured. In contrast, an equity security may be removed or delisted from the securities secondary trading on the exchange if it fails to meet the listing requirement of the exchange, which often include minimum share price, net worth, and free float. By the time an issuer's debt has become distressed, the equity securities will likely or have already been delisted. तो बहुत सी delisted companies होती है जिसके शेयर्स अब ट्रेड मार्केट में नहीं करते बट अभी भी उसकी डिस्ट्रेस डेट होती है मार्केट में. Many bond issues do not trade at all on a regular price. Many bond issues do not trade at all on a regular basis. Price quotes from dealers or on platforms such as Bloomberg for illiquid bonds often rely on estimates derived from liquid bonds of similar credit quality and maturity. Perfect. So we saw about credit facilities, credit rating agencies. When you are debut issuer, when you are issuing it for the first time, distressed debt, when you are unable to pay your debt, fallen agents, when you had an investment grade of A grade and then you got downgraded substantially, high yield bond issuers and issues rated BBB plus, BB plus or lower. If you are rated BB plus, BA1 in terms of Moody's scale or lower, then it is considered as high yield. अगर आप BBB नेगेटिव के ऊपर है तो आपका इन्वेस्टमेंट ग्रेड दिया जाएगा. Then primary bond markets, fixed income comprised of issuers issuing bonds to investors to raise capital, often intermediary by third parties such as investment bank. If you have already done a debut and if you have to reopen a bond, then it is considered as reopening. It can be at price slightly different from the par. Secondary bond market, fixed income markets comprised of investors trading existing bonds among themselves. Syndicate, a group of lenders typically made up of bank. Perfect. Fixed income markets for corporate issuers. This is a separate chapter.